It's underway. The US military can't build missiles anymore. A single sentence, that should be impossible. The most powerful military force in human history, the architect of the global security order, is hitting a wall not made of steel or concrete, but of something far more fragile. This is not a story about budgets, or political will, or even foreign adversaries. This is a story about a silent collapse, happening in the most secure warehouses, in the most advanced factories, a failure that starts with a single element on the periodic table, and it is sending a shockwave towards every boardroom, every investment portfolio, and the foundation of modern commerce itself. Welcome everyone to Wild East Stories. I am Marcus, recording this from my study in Lisbon, where I analyze the undercurrents that shape our world. For years, this channel has followed a simple rule. The most important stories are never on the front page. They are in the footnotes of financial reports, in the shipping manifests of forgotten ports, in the silent desperation of procurement officers. Today's story is one of those. It is a case study in how the modern world truly works, and how a single overlooked point of failure can bring systems to a halt. If you are a person who makes decisions, who builds things, or who simply wants to understand the gears turning behind the headlines, you are in the right place. For those of you who have been with us on this journey, you understand the value of seeing the pattern before it is obvious. If that describes you, please consider adding your voice to this community. Hit that subscribe button. It is the simplest way to ensure our paths cross again on this search for clarity. Now, a question for you. Where are you watching from today? The comments are always a fascinating map of our curious audience. Let us begin. The report was dry. A Pentagon contracting officer testified before a committee. The language was bureaucratic, but the meaning was tectonic. Production lines for critical missile systems were stalling. Not slowing, stalling. This was not about the Javelin or the Stinger missiles alone. Those were the names in the news. This was about a principle of modern industry had broken. The principle was simple. You design something, you procure the parts, you assemble it. The United States had mastered this. It had perfected the art of the global supply chain. It built things by gathering components from a dozen countries. This was efficient. It was lean. But it had a weakness. The weakness was visibility. A company could see its direct supplier. It could not see its supplier's supplier, or the supplier of that supplier. The missile shortage revealed this weakness. A military contractor could not complete a circuit board. They were waiting for a specialized capacitor. The factory making that capacitor could not source a specific silver paste. The refinery could not provide the required pure silver powder. The chain was only as strong as its most obscure link. That link was silver, not the silver of jewelry, not the silver of investment bars. This was industrial silver, a material with unique properties. It conducts electricity better than any other element. It handles heat and corrosion in ways alternatives cannot. For high reliability systems, in the heart of a guidance computer, or in the triggering mechanism of a warhead, there is no substitute. The military's specifications are rigid. A substitute material would require years of testing. Years they did not have. So the line stopped. The business community saw this as a military problem, a procurement failure, a news story. The wealth historian method sees it differently. It asks a simpler question. What does this mean for everything else? If the military, with its absolute priority, its cost is no object mandates, cannot secure a basic industrial input, what happens to the rest of the economy? What happens to the factory making life-saving medical scanners? They use the same silver pastes. What happens to the data center installing a new electrical switchgear? It uses silver-plated contacts. What happens to the automobile plant adding more sophisticated electronics? Silver is in every critical connection. The missile line stopping was not an anomaly. It was a canary in the coal mine. It was the first visible symptom of a supply chain infarction. The heart of modern manufacturing was seizing. The shock was not the event itself. The shock was the realization. The entire system was built on the assumption. The assumption was that raw materials would always be there. They were commodities. They were boring. Capital flowed to software and services. Mining and refining were afterthoughts. This was the great miscalculation. A modern business outsourced its manufacturing. It then outsourced its component sourcing. It finally outsourced the sourcing of the raw materials themselves. It created a chain of responsibility with no one responsible at the foundation. The Pentagon's problem was now everyone's problem. It just had not reached the quarterly earnings reports yet, but it would. The symptom was a paralyzed production line. The shock was the diagnosis. A deep structural anemia in the lifeblood of industry. And the patient was not just the military, the patient was the modern world. The natural question followed the shock. Why was there a shortage? Was the silver simply gone? The answer was more unsettling. The silver was everywhere, and it was nowhere. Consider the scale. Since World War II, humanity has mined over 1.5 million tons of silver. That is a staggering amount. enough to build a literal mountain of the metal. But this mountain is not in a vault. It is scattered. It is disseminated in microscopic quantities across the globe. It is in the landfill. It is in the forgotten drawer of an old television. It is in the junked car. It is in a discarded smartphone. This is the central paradox of the modern silver crisis. The element is not rare. It is irrecoverable. The industrial age used silver as a consumable, not as a currency to be saved. It was plated onto electrical contacts. It was printed into circuit boards. It was mixed into solars and brazing alloys. These applications used tiny amounts per unit. A few grams here, a fraction of a gram there. The design principle was performance, not recyclability. Recovering silver from a complex circuit board is a costly chemical puzzle. The value of the recovered metal often does not cover the cost of the process. So it is not done. The silver is buried. It is effectively lost to human use. Now, layer on a second reality. Demand quietly exploded. The digital revolution was, in truth, a silver revolution. Every computer server connection uses it. Every advanced automotive sensor relies on it. Every new solar panel placed on a roof depends on a thick paste of silver. The green energy transition became a massive silver sink. A single solar panel may not use much, but multiplied by millions of installations per year, the numbers become colossal. The demand was incremental. It was steady. It was invisible to the public. It was a slow, constant drip from a finite barrel. The mining industry saw this, but it could not respond quickly. Opening a new mine is a decade-long endeavor. It requires billions in capital. It faces immense regulatory and environmental hurdles. Capital markets were not interested. Why fund a dirty, difficult mining project when you could fund a sleek software company? The economics were broken. The price signal was too weak. Silver's price was set in trading pits. It was influenced by speculative funds and currency hedges. This paper price did not reflect the physical reality. It did not communicate the growing desperation in industrial procurement offices. So the drain continued. New uses consumed the silver. Old silver was not returned. New supply was constrained. The system operated on faith. Faith that the next ton would always be available. Then came the geopolitical tremor. A major war erupted in Europe. The military consumption of missiles and electronics spiked. The strategic stockpiles, long neglected, were called upon. They were found wanting. The just-in-time system met the just-in-case reality, just in case lost. The supply chain for missiles is merely the tip of the spear. It is the most sensitive instrument. It feels the shortage first. But the same supply chain feeds countless other industries. The root of the crisis is this. Humanity built a spectacular interconnected technological civilization on the assumption of infinite feedstock. It treated a critical strategic element as a disposable commodity. The market failed to send the correct signal. The industrialists failed to plan for scarcity. The policymakers failed to categorize silver as strategic. Now, the bill has arrived. The shortage is not a temporary blip. It is a permanent transition. We have moved from an age of abundance in key materials to an age of allocation. The military's crisis is merely the first, most visible invoice. The next invoices are being printed. They will be addressed to automotive companies, to electronics manufacturers, to renewable energy developers. They will all ask the same question the Pentagon is asking. Where will we get the silver? The answer is unclear, because the mountain of silver exists, but it is a mountain of dust, spread to the winds of progress and waste. Reclaiming it will be the great industrial challenge of the coming decade. It will require new chemistry, new business models, new priorities. The silent drain has reached its conclusion. The alarm is now sounding. The missile production line is the headline, but it is only the beginning. Consider a domino, not a child's toy, but a heavy stone domino. It stands at the start of a long, intricate line. The first domino is the silver shortage. It tips. It strikes the next domino in the sequence. That domino is the electronics industry. A factory in Texas waits for silver-coated components. The shipment is delayed. The assembly line for industrial automation equipment halts. This equipment was destined for a food packaging plant in Ohio. That plant cannot modernize its production. Its efficiency falls behind. Its costs rise. The ripple moves. A German manufacturer of MRI machines revises its delivery schedule. Their machines use silver in crucial superconducting coils. The lead time for new units extends from 6 months to 2 years. A hospital network in Canada postpones its expansion. Patients wait longer for critical diagnostics. This is not speculation. This is the mechanics of a tightly coupled system. Every modern industry is now connected by these thin, vital threads. Silver is one of those threads. When it snaps, the connections fray. The cascade moves from physical goods to financial instruments. Commodity traders see the volatility. They increase the premium for guaranteed physical delivery. This is called the physical squeeze. It means the price on the screen is a fiction. The real price is higher, much higher. Procurement managers discover this. Their annual contracts are void. Suppliers invoke force majeure. They cannot fulfill orders at the agreed price. Corporate budgets shatter. Financial planners did not account for this. Their risk models considered currency fluctuations. They considered interest rate changes. They did not model a shortage of a 47th atomic element. The cascade reaches investment. A venture capital firm funded a promising startup. The startup makes next-generation battery sensors. Their prototype requires a specific silver ink. They cannot source it. The startup pivots. It loses 6 months. The venture capitalists lose confidence. Funding dries up. Another domino falls. The true nature of the crisis reveals itself. It is not a supply chain problem. It is a signal failure. The market's pricing mechanism is broken. It no longer provides useful information. It does not tell miners to dig faster. It does not tell recyclers to innovate. It tells speculators to gamble. This misallocation of capital is catastrophic. It means the problem will get worse before it gets better. Capital needs time to flow to solutions. The cascade does not wait. It moves to geopolitics. Nations with large silver stockpiles gain silent leverage. Nations without them feel a new vulnerability. Trade negotiations acquire a hidden dimension. A clause about industrial cooperation might really be about access to metal. The foundation of trade shifts. From efficiency to security, this is a more expensive world, a slower world. Business plans written 5 years ago are now obsolete. They assume stability in the basement of the economy. The basement is shaking. The cascade touches the individual. Imagine an entrepreneur. She is launching a line of smart home devices. Her product design is brilliant. Her software is flawless. Her manufacturer sends an email. The cost for the internal wiring assemblies has increased 300%. The project is no longer viable. Her dream meets a physical reality, a reality of grams and ounces. The silver crisis is no longer a news headline. It is a killed project, a lost job, a foregone innovation. This is how a single point of failure breaks the chain. It does not break with a loud crash. It breaks with a whispered apology from a supplier, a whispered emergency meeting in a boardroom, a whispered revision of a growth forecast. The dominoes are not falling in a straight line. They are branching, touching everything. The cascade is exponential. Each failure creates 2 new points of stress. The system is seeking a new equilibrium. It will find one. But the journey there will be disruptive. The warning for the business community is clear. Map your dependencies, not just to your first-tier supplier, but to the raw material. Find the silver in your products, because if you do not, the cascade will find you. It is only a matter of which domino you are.
The crisis is not a conclusion, it is a commencement. We are at the end of one economic age and the start of another. The age of abundance in foundational materials is over. The age of scarcity and allocation has begun. This is not a doom-laden prophecy, it is a strategic reality. The rules of the game have changed. The businesses that survive and thrive will be those that understand the new rules. The first rule is visibility. You must see your entire chain, not just your assembly plant. You must trace every component to its raw mineral source. This is called vertical awareness. It will become a core business competency. As vital as financial accounting, companies will invest in supply chain radars, not just software, but relationships with geologists and metallurgists. They will pay a premium for certainty, not just for price, but for existence. The second rule is substitution. The great research race is already starting. Material scientists are working in labs worldwide. They are searching for alternatives to silver. Graphene inks, copper-nickel alloys, advanced polymers. Some solutions will work. Many will fail. The transition will be messy. Performance will suffer in some applications. Costs will rise in others. Innovation capital will flood this sector. The winners will build fortunes. The third rule is circularity. The linear economy is bankrupt. Take, make, dispose. That model is finished. The circular economy is now a strategic imperative, not a sustainability report bullet point. Recycling will evolve from an afterthought to a primary source. New companies will emerge. They will not mine the earth. They will mine the city, urban mining. They will develop advanced processes to reclaim silver and other elements from electronic waste, efficiently, profitably. This will be one of the great investment opportunities of the decade. The fourth rule is sovereignty. Nations are re-evaluating their strategic stockpiles. The era of globalization trusted the market to provide. That trust has been broken. National security is now tied to resource security. This leads to reshoring, not of finished products, but of critical processing. A refinery for high-purity silver may become more strategically vital than a military base. Trade agreements will include material clauses. Alliances will be tested by resource access. This is the new geopolitics. It is the politics of the periodic table. For the young entrepreneur, the path is clear. Do not build a business on a fragile foundation. Audit your idea for material dependency. Is your product vulnerable to a single point of failure? If so, redesign it. The next unicorn startup will not be a social media app. It will be a company that solves a critical material problem. For the investor, the mandate has shifted. Look past the balance sheet. Look at the bill of materials. A company with a secure, transparent supply chain is a lower-risk asset. It deserves a premium. This is the great realignment. Capital will flow from the virtual to the physical, from the abstract to the elemental. It is a return to the basics, but with the tools of the future. The silver crisis is our teacher. It has revealed the flaw in our complex, beautiful machine. We built a skyscraper on a foundation of sand. The foundation is shifting. We have two choices. We can watch the skyscraper lean and crack, or we can get to work. Pouring a new foundation. This work is not glamorous. It is difficult. It is granular.
It is the work of engineers and chemists, of logistics managers and mine planners, of visionary CEOs who think in decades, not quarters. The signal has been given. The old way is broken. The future belongs to the builders, the securers, the ones who understand that true progress requires a solid base. The age of scarcity is not an age of poverty. It is an age of intelligence. It demands more from us, more foresight, more ingenuity, more respect for the physical world that sustains us. The realignment has begun. The question is no longer what is happening. The question is, which side of the change are you on?